Hi, Benj. Thanks for being with us again today. Appreciate your time. And today we're going to be reviewing your last year. You had an incredible year, up 41%, which is just unbelievable. So, yeah, certainly want to explore that a bit. 10-year record is still incredible, of course, at 19.1%. 20-year record at 17.2%. These numbers are phenomenal, of course, like just absolutely, oh, congratulations.
Well, thank you, Todd. It's great to be back here with you. You know, we are very proud of our short-term numbers and long-term numbers. We've been doing the letter for 27 years, Contra the herd. We've had great results overall, and yeah, it certainly feels good when we get it right.
No kidding, no kidding. When was the last time you had a year like this, 40-ish percent? I mean,
I think it was 2013. I mean, there were 3 years in a row at one point where the lowest return was 47% and change, up to over 60% and change. Um, uh, that was unbelievable. Now, of course, we have had some losing years, but we've had some great numbers, and at this point, it's attributable to my business partner for 27 years, Ben Stadelman, Phil McKellar, Mark Taylor. Everybody pitches in, and it helps getting the input of these different minds and people, all of them who I believe are very bright.
yeah, absolutely, yeah. Fantastic team is certainly a big part of it. Um, I mean, it feels to me like you've certainly proven that, ability to produce these gains. I mean, 20 plus year track record, but, certainly with new subscribers, I think the question is, can you continue to do this? And I think it's a fair question. So yeah, maybe I'll put that over to you.
No, it's not very fair. No. It's a very fair question, and as they often say, past returns are not necessarily indicative of future returns. I think over time we've certainly got smarter, and we've learned, and we continue to learn both from our mistakes and what we do right. But predicting the future and how well we do, I really don't know. Um, it would be great to say, yeah, this is going to be a fait accompli, but it won't be, plain and simple. And a lot of it also depends on the stock markets. Last year, markets were fantastic. That certainly helped our returns. After 2000, when we had those three amazing years, we did way better than markets. So I don't know what the future is going to bring. Um, as I said, I think overall we're smarter. I think we have the potential to do better. That doesn't mean that we will do better. I always keep 15 to 25 stocks in the portfolio, so that diversifies to a certain degree. One way I sometimes look at the portfolio is how many stocks are up since we bought them. And after 2000, when the markets took a kicking and we took a beating too, I saw that most of our stocks were down in price, down from what we paid. So I thought, well, this is great. This is great for the portfolio. The difficulty was a lot of people who subscribed thought, well, no, you lost money in 2000. Therefore, I'm not going to renew. So I'm looking at something that looks great because we hadn't done so well. I was hoping for some sort of reversion to the mean, and ultimately we did better than that. So we'll wait and see. I mean, right now markets are up around record levels. So the odds are that there's going to be some sort of hit that takes place. Again, we'll get hit, hopefully not as badly, and hopefully have a quicker recovery.
Right. Yeah. Fair enough. Well, hopefully that's the way it plays out. I guess there's also been a lot of talk about a rotation to value, which could theoretically benefit you because you tend to be playing in that space. I mean, do you think there's any merit to that sort of line of thought?
Oh, absolutely. I mean, what we've seen the past few years is the tech's going up like crazy. So, the Amazon, the Shopify, the Netflix, um, they've done unbelievably well. Throw in a little Tesla just to ride on. And there's some people who were riding them and were doing exceedingly, exceedingly well. But now things seem to be moving more towards commodities. The techs this month, the NASDAQ as of yesterday, was down about 13% this year. So that's a lot. It's not surprising. Where people make mistakes is when they have portfolios that concentrate on just certain areas, be it technology, be it oil and gas, be it commodities, whatever it is. They may look really smart for a while, but often then they start to look really stupid. Now we get to avoid that. We certainly can look stupid at times, but because the portfolio that I have is diversified, it means it's not dependent on any one area. So, for example, in 2008, when there was the US banking crisis, we bought a lot of banking stocks for the portfolio that I manage. It was up to over 35% of the overall portfolio spread around, I think it was 4 banks. So there was some diversity in terms of the banks. At the same time, there was diversity in terms of the portfolio, but it wasn't like being all in oil and gas or all in technology. And because we're very disciplined in our sales approach, it means if things do really well, like the bank stocks did, we end up selling them often early, but sometimes near their highs, and we're then often investing in other things at the same time. So we're not betting the whole ship on a certain sector. I always think that's rather stupid.
Yeah, right. Well, on that note, I think you unloaded Bank of America recently. Do you want to speak to that one a little bit? It's been a fairly long-term hold, I think.
Yeah, we had held that since 2011, so it was about 10 years. The gain was 474%, plus dividends on top of that. We bought in at $6 and change. A lot of people thought the American banking system was going down. A lot of people thought that Bank of America had seen its best days, and there were major enterprises that, Lehman Brothers and others, that were going down and disappearing. But I looked at the CEO of Bank of America. I had a lot of faith in him. One of the things we wrote in our release when we bought it was psychologically, for Bank of America to go down would have really hurt the American psyche. This is the Bank of America. And what would Americans think if our bank goes down? So I was pretty confident, and it was kind of funny because the day after we bought it, a guy you might know of, Warren Buffett, Warren, he's a pretty good investor. He announced that he bought it, and that felt great. And I'd just been on TV on BNN Market Call, and Megsha did, and somebody mentioned, Warren, I guess Andrew Bell, who I was being interviewed by, he just bought it. So there seemed to be a lot of people taking Canadian pride in terms of I bought it just before. But if you look at the two deals, I just bought the stock, and it, obviously really well. But Warren got all kinds of bells and whistles with his stock, which made it much more worthwhile. Unfortunately, relative to Warren, I'm a relative peon, and they weren't going to give me all those bells and whistles. It's the nature of the beast. Anyhow.
Yeah. Okay. Maybe talking about, well, first let me just ask about patience, because I think it's relevant here. I mean, you've been holding Bank of America since 2011. That's quite a while. There would have been some periods where it didn't go up. It went down for a while. I know that's something a lot of investors struggle with, is just having the right amount of patience with a holding. So can you speak to that and how that plays into maybe some recent sales like INOD data as well, for example?
Yeah, it's something a lot of people don't have. And when I was on BNN regularly with Mark Bunting, he would say, how can you be so patient? And things have changed over the past 30 years. You go pre-internet, you go pre-cell phones, and people weren't getting all of this information all of the time. They weren't so tapped into the system. Now we're constantly getting bombarded with information, whether it's from your cell phone, from your computer screen, etc., which means people are more likely to react to information. So certainly I'm tapped into a certain degree, but not as much as some other people. My cell phone lives in my car. I don't take it out very much at all, except when I have to call home or something like that. So because of that, I'm less likely to react to certain things. So people react more. I think more young people tend to react more. Markets have a bad day or two, they'll react. They'll react because markets are doing really well and, FOMO. So, there's a lot to be said about being slower and thinking and getting away from the markets. A couple more examples. When we bought into Stewart and another funeral service, thank you, Service Corp and Stewart Enterprises. When we bought into those two funeral home operators, they were the two biggest in the United States. And one of them went down right away because they started digging up bodies to put other bodies in, which is something you can't do in the funeral business. So we paid about $354, and then it went down. Logically so, but we ended up holding both of them for over 10 years again, ended up with returns over 400% with dividends. So it was phenomenal what we did. But we looked years ago and our average hold time was about 3.5 years. So those examples are far longer. Sometimes we get lucky. Sometimes we'll buy into something and within a year there's a takeover offer, which is almost always done at a premium. But patience is absolutely key when investing, and not enough people have it. It doesn't cost them in the same way as it used to, because it used to be the service fees were so big. I mean, when I started and I wasn't investing a lot, it would cost about $150 for a trade. Well, now you can do it for nothing or for $10. So the fees really don't make much of a difference. But if you're trading in and out, it can cause problems. But at the same time as I say this, there's people who believe in dollar cost averaging, which means that you're putting money into certain stocks every month, which to me makes no sense because you don't know what price you're paying for each of those positions. It's kind of like going to the supermarket. Here in Toronto, I love buying fruit in the summer. The fruit is better and it's cheaper. In the winter, I don't want to necessarily pay a lot more money for fruit that doesn't taste as good. That's what dollar cost averaging does. Market timing, as you know, a lot of people, they don't like that. I believe in market timing to a degree. When markets are badly beaten up, that's a great time to buy. When markets have been going up like crazy, like the past 2 years since March 2000, and where they're at now, I will still buy some stocks, but I'm far more selective in terms of what I buy. I'm always selective, but you have to be warier because it's more likely that the market is going to come off. And if that happens, it doesn't matter really what you invest in. It's very difficult to avoid the stocks that you own going down.
Yeah, that makes sense.
How was that for a ramble?
It was good, yeah. Yeah. No, I mean, dollar cost averaging is just such a prevalent, philosophy, I suppose. So it's interesting to hear you say that.
Well, there's a good reason it's a prevalent philosophy. If you have a mutual fund or an ETF, people put money in every month. Well, you get fees from that additional money going in. So you want people to do it. You want to have more of their money under your umbrella. So it can be in the best interest of the funds and the ETFs. And Todd, I know, because you don't want to think negatively in any ways, but sometimes their goals and the goals of investors are not exactly the same. They're not harmonious. So of course, when investing, you have to really think, what are the goals of the other people? Of course, they want you to make money because then you're more likely to stay with them. But they also want to make sure that they're making money. So you have to keep that in mind and look to get lower costs, lower MERs, management expense ratios, keep the fees down. And that's absolutely critical.
No, it makes a lot of sense for sure. Yeah, I mean, your philosophy with all the buying you do in tax loss selling also speaks to why, you know, you clearly view that, yeah, it makes more sense to sort of time those purchases. There's a bit of an anomaly there, and you're able to take advantage of it typically. So
Exactly.
yeah. Okay, so moving on, we have to talk about real estate. You know, it's been hot for ages, and now we have some sort of a pivot happening with interest rates, yet to be determined, of course. I've heard sort of the terminal estimates around where interest rates land after they are raised is about 2.5%, something like that. To me, that doesn't make a lot of sense, simply because the last time there was a rate hiking cycle, a significant one, was 2004 to 2006, and that entailed 17 consecutive hikes. So, you know, it's pretty significant.
Great stat.
Yeah, it took a lot to do what they were trying to do, which was to minimize inflation. This time, inflation is obviously more acute. So yeah, just like your thoughts sort of on how interest rates, where they're likely to go. I mean, obviously that's a hard question to answer, but also, you know, how that plays into real estate in Canada, and what your thoughts are there.
I think the government made a major mistake yesterday. They did not raise rates again. And as I wrote it on my Twitter account at Benj Contra, you've got really smart people at the Bank of Canada, but really smart people can make dumb decisions. And I think that's what's happened. The interest rates should be raised. Historically, I think you're looking at about 6%, 7%. I think they went down way too far. I don't know, I was postulating today, well, maybe people in the Bank of Canada own a whole bunch of properties and they don't want interest rates to go up. I mean, that's very cynical. I'm not saying that's the truth. But they should go up. I think real estate in Canada went up about 26% last year. Historical record, it makes no sense. The government should have raised interest rates before, or the Bank of Canada. The whole key with this game is to look forward. You got to watch you're not focused on the rearview mirror. Unemployment is not bad here now. Omicron doesn't seem to be lethal for the most part. It's more like a flu. It seems to me that the government should have raised rates, and now they just keep talking 0.25%, maybe gone up 0.5. In March they should raise them. The more that they don't do it, the bigger of a hole that we're getting in. So I think part of the reason so many people bought houses last year and paid a lot is they knew they had these great interest rates. Typically, I believe what happens, once interest rates start going up, people will still buy because they want to buy before they go up even more. So I'm not saying that happens every time, but I think they have to really motor the rates up. Obviously, there's been somewhat of a psychological shift. I think it's late in terms of what they're doing. Will there be some negative consequences? Sure. The stock market in the past few days has had some real ups and downs like crazy. Markets are near historical levels. They should not be this high if you look at them in so many contexts. They are way ahead of where they should be. But of course, the government is also fearful, I think, in terms of the government debt has grown, I'll say exponentially. I'm exaggerating, but it's grown incredibly. The deficit, everything's up. And for the government to pay back, some of it is going to be very, very difficult. And if interest rates go up very much, it's going to put them in a bigger hole. And that's the case here, that's the case in the States, that's the case in many countries. But they really have to say, okay, at some point we do have to do that pivot. And there's certain reasons it's going to be tough. If you want to get more people into houses, you do have to build. But I think immigration's a great thing, so don't think I'm anti-immigrant. But we're looking at record immigration of over 400,000 people. Where do you house all those people? So say if it's 2.4 people a house, something like that, you've got to make a lot more dwellings to house all those people. That could be, let's call it 150,000, whatever. So you're constantly behind the eight ball by doing that. So in foreign ownership, I think we should do more like New Zealand and say, sorry guys, you're not coming in here and buying our properties. Plain and simple. More Canadian housing for Canadian people. Our government talks a reasonable game, but they don't, walk the talk, so to speak. And it's a shame. And it's actually a good time for them to do it, because the next election could be a fair bit of ways, unless, it is a minority government. But I don't think people in the government generally want elections, so they have a chance to really do something. And all they're doing is talking and sitting on their hands, and it's a real shame, because we're getting in worse and worse shape.
Yeah, I agree. Huh. I was thinking it's interesting too. I mean, maybe this is cynical, but well, just that part of the reason. I mean, obviously, there's interest rates rise, the cost to carry for your debt is obviously a lot higher. But there's got to be an element of government that doesn't mind a little bit of inflation, because it just helps with that debt burden, right? I mean, if inflation runs a bit hot, well then your hundreds of billions of dollars of debt aren't quite as burdensome. So I wonder if there's an element of that. Like they don't. On one hand they say one thing, but maybe you're a little bit okay with a little bit hotter inflation, because how else do you deal with this sort of gigantic debt burden that we know is out there? I don't know.
Yeah, I mean, it could be true to a degree. There would be a very negative response if there's long-term inflation at these levels. And inflation could go quite a bit higher. When it was still around 2%, again, I tweeted out that I thought it was going to go over 5%. And I think now it's 4.7% in Canada. It's higher in the States. So I still haven't been proven right here. But the government was saying it was so low, and I was going to the supermarket. And you didn't have to be a genius here and saying, whoa, prices have gone up. I would talk to other people. Prices had gone up. Filling my pump, filling my gas tank, prices had gone up. So, they could be willing to rest with higher inflation for a while, but people really, really dislike it. And of course, it makes it very difficult for a lot of people. I mean, I'm fortunate, okay, I go to the supermarket, prices are higher. I mean, I always look for sales, but I can still pay it. A lot of people aren't in that position. And I would say probably more and more people are getting in a position where it is harder to pay for things. And I sometimes wonder about, the people in the government and the people in Bank of Canada, people I'll say in the ivory towers, how much they commune with a lot of people who don't have things so good. And I have a feeling a lot of them don't necessarily do a lot of that. I mean, those people aren't going to their non-pandemic cocktail parties. So there you go.
But on that note, I've often thought, gee, how difficult would it be to be a 20-year-old right now, right? I mean, imagine trying to buy a house. I mean, it's not going to happen, right? I mean, it's a different time than 20, 30 years ago, where, theoretically you could get a regular job, work hard, make a half decent income, and buy a house for your family. But I mean, today, I just don't see how that's possible for the average person,
It's very hard. You've got a lot of parents helping out. But back between 93 and 95, I worked for a place called the Ontario Worker Co-op Federation. This is just before we started the investment ladder. And the goal of the organization was to set up cooperative businesses and take people off of unemployment and welfare to start a business. I mean, it was very, very lovely in terms of its goals. I was always a little cynical there, because for 3 people to start a business anyhow, it was very, very difficult. And for people who are, on unemployment and welfare, to have the skills, some of them do, but a lot of them don't. But to start a business with 3 of them was very difficult. So I would see a lot of it back then, and how many people, a lot of these people were just hanging on. And again, I think there's a lot more of that today. So I think, it's tough for people to buy houses. I mean, you look at the last year, and prices going up in the last 2 years so much. It's just made it way, way more difficult. And it's sad. And now, see, in Toronto, they're building all of these condos. And my dad would say, and excuse the expression, but there's not enough room for a pot to pee in because they're so small. Um, in many parts of the world, they would be really good. But here in Canada, I think the developers, in some ways, they control things too much. And I remember running into John Tory at a restaurant, actually, and I said, I think the developers, the real estate people, have too much control. And he said, the developers are a very strong lobby group. And they are. And they want more real estate to build. I mean, Doug Ford now in this province wants to change regulations. And I don't think he's that concerned about green space and the environment. So we have to watch how quickly we add to the population. We have to create spaces for people to live in. And I think we have to make them meaningful spaces in a Canadian way.
Yeah, no, definitely. I agree. Sticking with real estate here, and changing the subject a little bit though, I want to go to Evergrande. What's going on in China has been interesting. I was mentioning earlier that the total stock or the total value of Chinese real estate is double that of North America, or of the US anyway. Which to me is an interesting stat. You've got huge developers over there that are hugely levered, Evergrande, Countrywide. They're obviously going through some issues right now. How do you think that plays into both real estate over here, but also equity markets? Is there a systemic impact, and are you worried about it, or do you think it'll blow over? What are your thoughts?
Do I worry about it? Not so much, but maybe I should. I worry about less and less now. There could definitely be an impact. There's no question. I mean, a lot of North Americans, corporations, etc., they will be impacted if Evergrande stops paying what they have to pay, which they have to a degree. Debt can be a killer. It can be wonderful to expand, it can be wonderful to grow, but often it can be very, very evil and get corporations in major problems. It can place economies in major problems. So, the Chinese are trying to work their way out of it to some degree. And I don't profess for a second that I know what the Chinese government is going to do about this. I mean, they were allowing them to some degree to try and work out of it themselves, but they were backed into a corner. Was it realistic? I don't know. I'd have to take a good look at their balance sheets. I know a lot of people in China are depending on their residences being built. Some of them have already paid for them with a down payment, etc. I'm not sure how that's going to go and how much it could blow up in the economic face, so to speak. So there could be repercussions here. As we know, China and the US are not getting along really well right now. Chinese government, the leadership is exceedingly powerful. And what they're going to do from this point on, I'm not sure. But they do have major problems there to deal with major corporations that are having difficulties.
Okay, good to know. Yeah, good thoughts. I'm going to pivot to a different one here now. So your philosophy is typically to sell 50% of the position after you've reached your initial target. Mm-hmm. You've said that sort of at that point, then you sort of assess the market from a timing perspective and look at what's going on and try to exit accordingly beyond that. Obviously, things went a bit further than expected this time around with things like KOSS and BlackBerry, perhaps. So yeah, I'd be interested to sort of know how you manage that second leg essentially after you've sold your first percent or first.
Okay, so this all starts with whenever I buy a stock, I set an initial sell target, or even before I buy it. So what that does is it grounds me to some degree. So that takes a lot of emotion out of the decision. So I set the target, and then for the most part, I sell around the sell price. Now there's some exceptions to the rule. For example, if the stock has had huge gains and hits the sell price in November, December, I might not sell because what I want to do is defer it to the following year so that I can defer taxation. So that's, one reason. But for the most part, I do. Now sometimes I'll sell the whole position, sometimes 75%, but usually at least 50%. How do I time it afterwards? It's partially where the stock market is. It's partially based on the historical position of where the stock price has been. It's partially on how I think the company is doing and maybe the sector is doing. And Bank of America was a good example. I sold some of it about $33 and change, and the rest at $38 and change. So to me, it makes sense. I'd love to say that this is a precise science, but it isn't. So we do the best that we can in each situation. But again, grounding at the beginning is key. If I think the stock has tremendous momentum, I could stay and wait, again, looking at the past, and then hopefully making that much more. By selling part of the position, at least I've gotten some of that money on the table, and again, based very much on a number that made sense to me when I bought it.
And that doesn't typically change too much for you, you find?
It can change to some degree sometimes, but it's pretty rare. Sometimes I'll look at it. A good example is Fidelity Southern, and I like the symbol on that one. It was Lion. It was another bank in the United States, and it got to about 18, I guess, and my target I think was about 21. Bought it at $3 and change, and I was thinking, is this the initial sell target high? Maybe I should just off some of it now. So I wrote to Ben and Phil and Mark, who I mentioned before, and said, is it high, the sell target? And Ben said, no, it seems reasonable. I was the one who was most cynical about this sell target that I had set, and then I guess it was about 6 months later it hit the sell target, or 3 months, I forget. So let's say then it went up another 15% or so. So if it goes up 15% in 6 months, that's mighty good. In 3 months, that's mighty good. But there's no question that sometimes I think the target is too high, and other times, well, maybe not high enough. But usually if it's not high enough, I'll still sell it, but I'll sell a smaller percentage.
And sometimes you underestimate the euphoria by the sounds of it with something like a KOSS.
Oh, almost everything that I sell goes up further. And KOSS was a weird situation. It became a meme stock. I wish I'd held it a few days more because it went up like crazy. It was a $1 stock when we bought it that went as high as $127. So there was absolutely no logic to it based on anything except it was a meme. And until that happened with KOSS and Blackberries, I didn't know what meme stocks were. So then I went and did research on them and said, okay, now I have an understanding of meme stocks. At this moment in time, meme stocks do not seem to be playing as much as they used to be. So it was certainly a special time. I'm always making mistakes to some degree. Still, the returns have been fabulous. I keep trying to get smarter.
I was going to say 41% last year doesn't sound like you made too many mistakes, but it's all, hindsight's always crystal clear, I suppose. Maybe before we should maybe move on to some buys here. So you recently bought Mobile Telesystems. Can you give us an update on that one?
Yeah, this is a Russian telecom stock. It's the largest in Russia. They're in other countries. I like the management. They pay a fabulous dividend. The dividend is different than in U.S. and Canadian companies because they change the dividend every quarter. So it's based largely on how they do. The stock has just taken a bit of a beating over the past month or so because of the Russia-Ukraine problems. I think that's the primary reason. The ratings were literally just confirmed this week, so they weren't downgraded. I like it a lot. I mean, we paid $8 and change. I think it can do better than a double. Everything I buy, I figure can do better than a double or triple, quadruple. So I'm happy to hold it. But we mentioned, we always send an email release when we buy something. We mentioned specifically the geopolitical risk. Now, on the one hand, going into Russia gives us some diversification. On the other hand, of course, Russia's got certain dangers. And the U.S. and Russia are not getting along well now. Mr. Putin, he is a very strong leader. He'll make some decisions that aren't in the best interest of North America. And the stock, I think, has taken a beating because of it. But as people have heard me say, if they've listened to me before, one of my quotes, I suppose, is dividends allow me to be stupid longer. So they're paying a great dividend. So the stock goes down. At least I'm getting some sort of payback. Hopefully it'll go up sooner rather than later.
Fair enough. So if the U.S. puts, strong sanctions on Russia, if they were to do something, let's say, with regard to Ukraine, is there anything that Russia could do back that would be detrimental? Is that a concern at all, or?
Well, Russia, if they invade the Ukraine, there's going to be sanctions, additional sanctions against them. There will be sanctions against the leaders. I mean, the Canadian government is talking about, helping the Ukraine out. They're giving them $120 million, maybe arming them to some degree. The U.S. is making more warlike noises. Canadians going there and offering certain things. Russia goes into the Ukraine, they're going to take the Ukraine. For the U.S. to go over, or NATO to do something, it's going to be exceedingly, exceedingly difficult. And when the U.S. went into Afghanistan, I said at that point in time, going back 20 years, this is folly. All you had to do was look historically at Britain going in before, at Russia going in before, and you couldn't win in Afghanistan the way I looked at things. And it cost them an absolute fortune. It cost them lives. It cost Canada money. It cost Canada lives. One of my very close friends was in Afghanistan for 4 years. So you've got to think it's great to try and defend certain people. But I think you're going to have to do mostly economic sanctions, and maybe you can wave the flag and wave the arms. But there's no way you'll beat Russia if they get serious about going in. It's just not very doable.
Yeah, no, fair enough. Okay, well, that maybe leads into my next question, in that safe haven assets are sometimes desirable in these sorts of situations. So what are your thoughts on Yamana Gold, I should say?
Well, Yamana Gold is a company that we really like. They have 5 producing mines. They're all operating at either record levels or close to it. Good balance sheet, pay a dividend. We bought it at the end of last year at $5.16. I don't know where it's at today, but it was around that level recently. I don't consider gold to be a safe haven. A lot of people do. I mean, remember years ago, gold went from, let's call it 200 and change to $850, then back to $250. You can't have something that has a price go way down like that and call it a safe haven.
So you're saying Bitcoin isn't a safe haven either?
Yeah, right. So it is an alternative. So if somebody wants to have an alternative, Bitcoin is a good alternative, I think, but I certainly wouldn't want to put that much into it. And right now, because governments are, as we talked about before, printing so much currencies, there would probably be more devaluation of currencies, but it's kind of like a domino theory. Almost all of them are doing it. So relatively, it stays the same. So again, gold to me isn't a safe haven. I mean, a lot of people go to U.S. bonds as a safe haven. Doesn't make a lot of sense to me. Germany, finally, the 10-year bond, I believe, has just gone into positive territory. You know, it's worth nothing if you bought a 10-year bond. And I was very against negative interest rates. I think that's stupid. It's not fair to people who save. I don't think it makes a lot of sense. They were used to combat deflation. And when deflation was right in the news, I said it doesn't make sense to me. I don't think there'll be deflation. And if you have deflation of 1 or 2%, and a lot of economists will disagree with me, I don't think that's that bad. If deflation goes into double digits like it did in the Depression, that's bad. Because then people might wait to buy something. But if it's 1 or 2%, it doesn't matter so much. Are you going to wait to buy the car so next year it might be 1% less? It's doubtful to me. I had a debate about this with someone who's very intelligent. He said people will wait. I said I don't see it. Plain and simple. So I think it's a bit like a bogeyman. And people got scared. And again, I was out there saying, you know, waving that "don't worry about it" flag. But you know, I work out of the house. I get out. I have less of an audience right now because I'm not on BNN right now. I still write for the Globe. But you know, people at the Bank of Canada, etc., might not listen to me so quickly.
I think the economics of big screen TVs proves your point pretty well, right? I mean, they've been deflating for years and years and years. I mean, it's cheaper and cheaper and cheaper every year, but people still buy TVs as far as I can tell. So,
and yet, it was a bit of a different situation too because they were coming down so quickly. So you weren't talking 1 or 2%. You were talking, wow, I can buy 10 inches more for 20% less. So people who were patient did well. When we moved into this house 15 years ago, we bought a great TV set for the time, and it cost, I think it was around $5,000 or something. I mean, it was really expensive. We put in a lovely sound system with it. And I think part of the rationale was, okay, new house, let's get off our little box. Normally, I'm very careful when I buy things. That was a bit of an exception. And I think we've talked about it before. I love buying things on sale. And I've talked about it with my kids. If you can buy something $100 less and you're in the 50-cent tax bracket, that's $200 less that you have to earn. So I've really worked my kids to buy during sales, buy during, Black Friday, which is when I bought some stuff this year, buy during Boxing Week or Boxing Month. So I always try and do that. But again, you were talking about patience before. Some people, they don't have that patience.
Right. Yeah, makes sense. Good thoughts. Okay, so my next one is actually on Canfor. I noticed you own Canfor, and to me that seems like a little bit of well, maybe not a play, but at least you would have to have some view probably on the price of lumber, and lumber is currently trading at $1,100, which is historically elevated. So yeah, curious to know sort of high-level thoughts on Canfor.
Well, I don't hold that one, but Phil and Ben do. I think it's a great one. When I discover a stock, I wait at least 6 months before buying it. And Phil and Ben pointed that one out to me. I'm still in that waiting period. My dad was in the lumber business. He owned lumber yards. I went on buying trips with him to St. Félicien, Quebec, and to Hearst and Timmins in Ontario. So he died a number of years ago, and my 3 sisters were saying when lumber prices went through the roof, oh, Dad would have found this fascinating, seeing what's going on. So there's no question Canfor is a lumber play, and I think Canfor is going to do good longer term. I mean, once again, we're squabbling with the U.S. about tariffs and lumber tariffs, and it just seems silly that we end up doing this all the time. But I think it's going to be a good stock, a good play. They've got good management. I'm surprised the stock is at around a 52-week low right now. I'm surprised it hasn't rebounded more. But timing can often be a little bit difficult. But yeah, I think that's going to be a good play. It just might take some time. And I think this week I'll look at it more closely again just to get a better idea exactly where it's at.
Well, and I guess that kind of company too has a lot of hard assets, which somewhat benefit from inflation, and that the replacement cost of those assets is presumably going up over time. And if they're carrying a lot of debt, the debt's worth less as well. So there's sort of that view, I suppose.
And with me, as you know, I'm very debt averse. Of course, I buy companies with some debt. I don't know how bloated that company is with debt. I'll have to look. And debt can change on a relative level. If the company has X number of dollars in debt and sales go down, debt relative to sales is very important. But again, I'm not saying this company fits into that module, so to speak. But I don't know the company well enough to actually buy into it. But I know Ben and Phil, they're two very, very bright people, and they both have confidence, which gives me more confidence in it.
I'll have to prod Phil on that one next time. I was just thinking your comment on debt there just brought me back to the discussion about safe havens and U.S. Treasuries. I was thinking how funny, a 20-year U.S. Treasury bond is sort of the definition of a safe haven asset. But with 7% inflation in the U.S., is that really a safe haven asset?
Yeah, and I think people get a little confused because they sometimes end up chasing returns relative to inflation. Well, to me, that doesn't make a lot of sense. So, when Paul Volcker was the big cheese in the U.S. and pushed interest rates up to around 20%, that was, it was a crazy, crazy time. But were you really going to get 20% relative in return? Very, very difficult to do. So I think you have to be a bit more pragmatic and think, okay, you still have to evaluate risk and reward. What higher return can I get relative to risk? And you can't, I certainly don't think relative to inflation, what am I going to get? But I know that's a common thing that people look at. I certainly don't focus on it at all, really, or very, very limited. I'm looking, where can I get that good return?
Yeah.
And what's the risk associated with it?
Sure, makes sense, yeah. Okay, my last one is on First U.S. Bank shares. Do you have thoughts there? It's been a recent purchase, I believe.
Yeah, it's one of the few banks that I still own. I still own some. It's the only bank that hasn't moved that much. So I think it still has a lot of upside. I think it could double. It's nice that it pays a dividend every quarter. I think it has very good management. It's just been a real laggard. So it's a small bank in the States. A lot of people, they don't have the patience I do. I just sit back, I clip the dividend coupon, and I'll wait. And there's nothing linear about the returns, Todd, as you know. A stock can stay down for a long time, and then all of a sudden it goes blip, 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 as my business partner Ben might say, and then you can get a fantastic return. But often you have to wait, and then, it can catch a wave. It starts to catch people's eye. It's done really well. A lot of momentum investors get involved, and it wouldn't surprise me if this company ends up doing that.
Right, that makes sense. I mean, theoretically, banks should benefit from higher interest rates as well. Would that be part of the thesis? I mean, net interest margins should improve over time if rates do rise. Is that?
Absolutely. Yeah. Interest rates go up, the bank should do better. Absolutely. So we could get into a bit more of a sweet spot for the banks in the next while.
Perfect. Okay, well that wraps it up, I think. Congratulations again on a fantastic year and some incredible winners that were closed out this year. So, yeah.
Well, thank you, Todd. Appreciate it. Always appreciate being interviewed by you. And I'm thinking of getting my bow tie out now, and maybe I'll wear it this weekend, although given the lockdown, I don't have a lot of places to go.
This is about it for me too, so.
Yeah, I hear you.
Good. All right. Well, thanks a lot, Benj. Thanks for coming.
Thank you. Take care now.